Hey, welcome to the live stream. It is August 13th. It is the afternoon, evening. Market has closed and we're on to the after hours. It was a good day overall. It was a positive day for the S&P, positive day for the Dow. That's what really did the best today. And the Nasdaq was up slightly. Bitcoin continues to rise. It's up in the 120,000 plus zone, which is good to see. Apple was up, Amazon was up, Berkshire Hathaway was up, Visa was up, Eli Lilly was up. Those stocks are looking good. A good variety of stocks were up, and some of the stocks that flourished yesterday, I could say firsthand, Meta is down today, but yesterday was up like 3.15. So it gave back some of what it gained yesterday, but I mean, it just did terrific yesterday. AMD was up nicely. Qualcomm was up. There's just a lot of stocks that were up today. It was a pretty good day. And overall, we're through earnings. We got a couple names that came up. We had Cisco announced after the market closed. I wanted to take a look at that. I haven't looked at it at all, so we can look at it together and see what they had to announce, see if it was good or bad. So we had a terrific stream this morning. I don't know if you had a chance to see the recording or attended live. Thanks so much to everybody who attended. And we had 3 people sign up as new members of the paid, channel, which is awesome. Thanks so much to those that got signed up, as well as the people that are already members. And it's a really good program. I encourage you to think about it. It's 3 levels. And on live streams like this, you get to put tickers out there and I'll analyze them. I'll review them. If you're not a member, you pay a $5 super chat per ticker. So you can see that you're getting a pretty good value by being a member. You also get access to my research. You get access to member calls. You can get access to the Discord as well. So take a peek if it's something good for you. It's easy to get signed up. Go to the home screen of my YouTube channel and you can take a look at the options there. You look for the join button toward the bottom of the screen. All right. So what's my channel all about? What am I trying to do? I'm trying to find stocks that are priced right, that are discounted based on the intrinsic value of cash flows that a company is going to produce. It doesn't mean that I don't buy growth stocks. I don't buy technology stocks and communication services stocks. I love those stocks. I love growth stocks. I love technology stocks. I just want a good price. Is that too much to ask? And if you're patient and you do your homework, you can find those stocks. And that's what I do. Now, when we look at a company, I'm going to look through the lens of what do their cash flows look like? And I'm going to do a net present value of their cash flows and value them to today's value. I'm also going to look at their earnings per share, value the earnings per share, and determine what the value of the profits for that company are going to be. Then compare it to the stock price to see what the difference is. If you have a very desirable company like a Microsoft, paying fair price is fine, meaning the value of the cash flows and earnings per share is right around the current stock price. Hey, that makes a lot of sense. But maybe a higher risk stock, something that isn't as great and desirable as Microsoft, maybe you want a compelling discount. Hey, I'm taking a higher risk. I want a very good return. I want a higher margin of safety, as some people call it. So that's my point of view. That's how I go about things. And as I look at companies, that's going to be the way that I look at the company and gauge if they're good or bad, a good investment or a bad investment. I have a good model that I've built, created on a Google Sheet, and I'll be going through that model with you today as well. So if you've got stocks you want me to look at, put them in the chat and we'll take a look at them. All right. So I have a list of stocks that we can get going on. And it starts off with this morning's session was very well attended. We went over 2 hours and an attendee actually put in, he requested 4 different stocks for me to look at. And I've got 2 left to go. So I thought I'd start there. Looks like Eric Johnson is on. Good to see you, Eric. Thanks for joining. You are a regular, sir. I appreciate it. And the first stock we're going to look at is Geodrill. Geodrill, together with its subsidiaries, provides mineral exploration drilling services to the mining companies in West Africa, Egypt, Chile, and Peru. It offers reverse circulation core, air core, deep directional navi, water borehole, underground and horizontal drilling services, as well as reverse circulation grade control services. So miners in these countries need somebody with specialization and the equipment to come out and help them mine for the minerals they're looking to get in those countries. And this company, Geodrill, is providing those services. This was a request by somebody, and I'm going to go through and analyze the company completely. So this is a small cap, $166.49 million. By today's standards, this is a really small company. Revenue is $226 million. So you see that you're paying, half. Market cap is 1/2 of sales revenue. And I'll make a point later about that. For now, let's move on. The PE ratio is low at 9.5. Forward PE, 9.82. When we look at, and this is traded on the Toronto Exchange, you can get it in the over-the-counter market here in the US, but I thought I'd stick with where this stock is being traded. Quick glance at the profile. The country that they're incorporated is Isle of Man. And I believe that's a territory that belongs to the UK. All right. Looking at their financials, they have good growth and they are somewhat cyclical. They have periods when they grow really well and then they contract. Revenue comes down and then revenue goes up, revenue comes down. It kind of makes sense. They're needed to provide services for the mining industry. They get those services done and then companies don't need them, anymore once the operation is good to go. And I think that's Bushy. You want to look at PetroTal. Yeah, we can look at that. That'll be third up. PetroTal. And I'll try to monitor the chat. I felt bad because this morning there was so many chat messages. I think I missed one or two, and felt bad that some people are waiting for a while. I don't mean to do that. Obviously I'm trying to do two things at one time. But back to Geodrill. So their growth is cyclical. The margin, since this is a service-based company, their margins are not overly exciting. 24%. It's not bad for a services company, but I like margins in 70% or higher, like 85%, 75%. Because then those companies are far more valuable because they're able to keep more profit, more cash flow. A company like this has a lower ceiling. Early in my review of the stock, I pointed out that the market cap of this company is about half of their revenue size. My conclusion is companies like this that are services based have a low ceiling, meaning the value will never be really high. Like let's say a Microsoft or a Meta. No, because if these guys were to grow, they have to hire people. They have to buy equipment. It takes a lot of capital and it takes a lot of expense for them to grow. And that gross margin is telling us that, this is the cost of producing the services is quite high. So that's one of the things that's just a reality with a stock. It's going to have a low ceiling. It'll never be worth a tremendous amount. Okay. They do have some cash flow, about $4 million. That's not all that great. $4 million. And you see that there's no consistency there. It's kind of up, down, flat, up, down, flat, up. So if you look at the chart, there's no trend to that chart. What's going to come next? It'd just be like guessing. I don't know. They might be up. They might be down. I'm not very confident in the data. So that's kind of a reality with this stock. They're services based. So they're going to react to what the mining industry needs. And in this case here, it's cyclical. Sometimes they need them, sometimes they don't get needed. So that's one of the realities. At $4 million of free cash flow, I'm going to look at their balance sheet and then give you a valuation of this stock. So their balance sheet has $34 million of cash and $22 million of debt. No problem with debt. They have a $12 million surplus of cash. Good for them. Now, based on their cash flow, they didn't cash flow very well, frankly. I think some of their best years were like 9 million. Let's see here. See, they had a 9 million and 8 million, but then some negative numbers. More recently, 4 million. So I would say that they're probably worth 100 million. And that's like being pretty generous, maybe 120 million. If I take $4 million, multiply it times 20, gets us to 80 million. And maybe I multiply it times 25, gets us to 100 million. You add that cash on the balance sheet, gets us just over $100 million. And their market cap is 166 million. So this stock is not a good investment for me. I don't think that the value of this business is going to continue to go up because it's cyclical. They're probably going to have a down year a year from now, maybe two. And where the stock's been, it's up 24% over the 1 year. Over the 5 year, it's up 74%. You see that there was a pretty drastic sell-off starting in April of 2023, and it sold off up until mid 2024. Then it started a really nice climb. That climb looks good, but again, I don't know that it's going to be sustainable. This is a cyclical business. You're probably going to see another downturn like this and maybe setting up to really sell off. If the mines don't need their services, it'll definitely sell off. So this one here, there's not enough value out there. The margins are low, gross margins are low, free cash flow is low. The data doesn't really have a good trend to it. So this one here is a pass for me. It's a stock that I wouldn't even watch it because it's just not a desirable business in a desirable industry. And that is Geodrill. For a viewer that wanted me to take a look at that stock, I hope you found my analysis interesting. And if you want to put questions in the chat, I'd be happy to answer those questions. Moving on to the next stock is a Dynacor. The same person asked me to take a look at this one. This one is in the same industry, but different type of company, or I should say it's in the same ecosystem, I'm going to call it. Now, this company is actually a mining company. They engage in the exploration, development, and mining of minerals. So this is the miner, and they have properties in Peru. The company explores for gold, silver, copper, and other precious metal deposits. Now that looks good. Two things look really good. Copper, the price of copper keeps going up, and the price of gold keeps going up. So I am curious to see how are the revenues for Dynacor going. That's the right those are the right commodities, minerals to be extracting these days. And they operate in Peru. This is a company that is, let me see where they're headquartered. So they're headquartered in Canada, in Quebec. So, all right. So that looks good. Looking at the valuation of the business, this one here has a market cap of 203 million. Revenue is 421. Again, we're looking at a business that is valued at pretty much half their revenue. PE is low. Okay. Now, when we look at this business, year to date, it's down. Over the 1 year, it's down. Over the 5 year, it's up nicely. I think when gold had that run, this stock was really moving, but it's been kind of going sideways, consolidating, not really having any trajectory to the upside. So is that an opportunity? Well, let's keep looking at the numbers. So when we look at the numbers, something I like is there's consistent green. And for the last 5 years, nice green numbers. 1 year was a little flat, but still grew a little bit. And hey, there we go. The person who asked for Geodrill and Dynacore is on the stream. Very good to see you, KGel. I'm right in the middle of Dynacore, one of the stocks you wanted me to look at. And one thing I do for companies, or I should say, the data with the COVID year, I kind of throw it out. It was a pandemic. It's just not good data to bring into the analysis. These guys, I do like their growth. Okay, it's been growing for 5 years. Gross profit. We'll take a look at their gross profit margins in a little bit. Free cash flow. They do cash flow. $8 million, $10 million in 2024, $3 million in 2023. Okay. Gross margins here, they're pretty low. These mining companies, it costs a lot of money to mine. You got to put expensive equipment into operations. You need to hire a lot of people. You need to travel to a location that's way out there. And at the end of the day, you have a gross margin. Now, I would say that if they're extracting a commodity, it's pretty easy to sell that commodity. It's not like you finally extracted it and then you have to sell this commodity with a lot of expense. No, I think there's markets that are willing to buy this and buy it off your hands quite quickly. You can see that the gross margin, there's very little expense between gross margin and operating margin. So overall, these guys are profitable. That's good to see. Now what I'll do is I'm going to do a full valuation on this one and put it into my model. Let me just take a look at their spread balance sheet real quick, and then we'll go from there. Looks like Ben 10 wants me to look at PRMB. Happy to do so. And I see a lot of comments coming through. Thanks, everybody. And let's see, Dynacore is not a mining company. Where did I go wrong there? Let me back up a little bit. So Dynacore engages in the exploration, development, and mining of mineral properties in Peru. Maybe it's described wrong. Let's take a look at their website. So this is Dynacore. So I think they are a mining company. The impact of Dynacore's group's activities is well-being mining communities. Okay. So it looks like they want to be a processor of gold, but the actual people in that region are bringing their iron ore to Dynacore. So they're more of a processor. So I think that's your point. Thanks for pointing that out. Okay. All right. Got it. And I guess they bring the equipment to a region and then they're able to, I guess, work with the people that are bringing their gold ore, and then they process it for the people that are actually doing the mining. Got it. Got it. Thank you. Thanks for clarifying that. I assumed something incorrectly. Okay, so I wanted to check on their balance sheet. Let's take a look at their balance sheet. I want to make sure we don't have too much debt. We've got cash of 79.6 million, debt of 949 million. No, that's 949,000. Sorry. These numbers threw me off. So net cash of 78.68 million. Very good balance sheet. Plenty of cash. Looks good. And here's something interesting. They have 78 million on the balance sheet cash, ready to go, ready to write a check. Their market cap's 203 million. So they have roughly about 35% of the market cap in the form of cash on the balance sheet. That just tells me it's like buying a used car, and in the trunk of the car is a suitcase with $5,000. And somebody's selling you the car for 10,000. You're like, hey, I'll buy the car. It comes with a suitcase, right? Yeah. Because you feel like, well, I'm only paying 5,000 for the car because there's just $5,000 a suitcase with $5,000 in the trunk. It's a little bit like that. You're buying a stock for a company, partial share of this business, but the business has a lot of cash on the balance sheet. So keep that in mind because I'm going to include that in my valuation. Okay, so we've got that. I think I've got enough to go into a valuation for this company. Let's crack this one open and see where they're going to be valued. So I don't have a ton of companies like this one. I haven't been into gold miners or gold processing companies, but I do have some oil companies. So let's match it up with some oil companies. I'm not going to use the same numbers, but I'm going to use the template that I used with Occidental Oil as kind of the starting point where I will do the valuation on this guy. All right, so okay, so we're going to go with all right, the symbol was, I don't know if my Google Sheets is going to pick this up, but we'll give it a whirl. No, it didn't work. So okay, so I'll just have to input some numbers manually. No big deal. We'll just put those in manually. So this is Dynacor Group. Now, this is a riskier business to me. I'm going to go with a 10 discount rate because it's just riskier. It's out of my home country. They're doing business down in Peru, just got a lot of international exposure there. The growth rate, they were growing their revenues nicely. And I'm going to open up the information I was showing earlier in a screen that you guys can't see. So just bear with me while I do that. And I can pick out the information that I wanted to go over. So the cash flow, I'm going to go with the trailing 12 months. And their cash flow for the trailing 12 months was 8,000 or 8 million, excuse me. So it's 8 million. Okay. Now, from a growth perspective, they're growing their top line revenues 17%. They've been a consistent grower. That's good. Okay. Now, the margins are really tight. So if they grow at that rate, yeah, I think it'll be okay. So we'll grow at 15%. Long-term growth 4%. That's fine. So their cash is going to be, I think it was So it was 79 million. And they had roughly $1 million of debt. So we'll go with 78 million in. We'll go with 79 million in cash and 1 million in debt. Equity value is 246. So the stock price for this company currently is, and this is in Canadian currency, but it's pretty close. I think everything that I'm showing is in Canadian currency, by the way. So I should put that up here. This is in okay. Shares outstanding is 41 million. Okay, so market cap looks right. Okay. So based on their cash flows and a discount rate of 10%, this stock, based on cash flows, is discounted by 17%. If I look at the intrinsic value of their cash flow forecast plus cash, gets me to 243. So it has a, I'm going to call it smallish discount. Let's take a look at earnings per share. So the earnings per share on the company for the trailing 12 months has been 42 cents per share. They've been growing it nicely. So we'll grow it. So we'll go with I'm going to grow it by 15%. Their PE, this is it's part of the mining industry. So I think the PEs were around 9. Maybe we'll go to 10 since they are involved in gold and copper. I think those commodities are doing well. It's supposed to grow by 15%. So we have, based on earnings per share, it's discounted by 13%. So there's about a 15% discount available on DNG Dynacor. If I look at their free cash flow forecast and I look at their earnings per share, so the numbers come straight out of their performance. And when you look at the net profitability, it has been growing around 15%. These numbers, if you do a quick scan, you can see that 15% would, I think, represent these numbers well. And their cash flow numbers are also going to grow by 10 to 15%. Now, the reason that these businesses don't find their way into my portfolio is there's just not enough lucrative business here. I like businesses that have higher margins and at some point are going to hit a scale and just really go up in value. This one here has a modest discount, but that's not enough discount for me to become an investor. This is an industry that I don't have a lot of in-depth knowledge on, and I'm probably taking a higher risk. If you have a better knowledge of this business and are more comfortable with it, maybe you went to a discount rate of 9. That would improve the discount to some extent. So that's my evaluation of Dynacor. It's a small discount. It's not enough to compel me to become a buyer or even say, hey, you know what, I would buy that. I do have some material stocks that I'm invested in, and one of them is quite interesting. I'd like to show that to you, but let me look at your comments because you had some really good stuff that you were sharing. And let me go back a little bit here. Okay, so they're a processor of ore. Got it. Got it. So we're on the same page there. They do have, they're probably low margin because it probably takes a lot of energy to run those machines that are somewhat, they're put on in remote areas. So I want to say it's transportable equipment that's probably running on diesel or some type of fuel. And that fuel is probably pricey. They also have to hire employees that are going to run the equipment, all kinds of expense there. Got it. So you bought Dynacore at $2.40. The stock is trading at $4.84. Nice job. Let's take a look at where the stock has been. You did well. Nice work. So you doubled your money and are sitting on a really nice gain. That's what I'm trying to do over 5 years, is double my money. It looks really good. So I'm curious, are you really do you feel like you have a knowledge advantage in mining? Is that why you like mining stocks? Some of the ore come from pirate miners. Oh no. And those are, I imagine, are people that just start drilling into a place where they don't own the rights to drill, I imagine. All right. The company that I wanted to show was AMR. Different type of mining, but maybe you'll find it interesting. This stock has been places. It went sky high a couple of years ago, up 2,583%. And then it came back down to earth. And boy, it had a lot of velocity as it approached the earth. It came down 74%. Now it's up nicely, 42% in the last month. What's going on with Alpha Metallurgical Resources, and what are they to begin with? This is a mining company that extracts coal out of the Appalachian region that is in Virginia as well as West Virginia. And this coal goes into the steel producing industry. So they produce that as a raw material into that production. Now, what's interesting about Alpha Metallurgical, AMR, is that although their stock price went way up, way down, the company continues to produce profits. And these companies are dependent on a commodity price. AMR most certainly was. And when they were growing due to the commodity price increase, remember those inflationary years we had, 2022 being a high inflation year, these guys were making a lot of money. Their revenue went up even though their volumes were about the same, and they benefited, they profited. And then since then, the commodity prices come down, but they've maintained their cash flow, which is interesting. Even though they're not getting the same amount for that commodity, their cash flow has been positive. That's really good. And in their boom year, 1.3 billion in free cash flow. When we look at the market cap of this business, it's quite low in proportion to that cash flow. This is a cyclical business. You got to buy it at the right time. And I felt like the right time came. And I think it's not necessarily early, but it's not too late, because when I look at AMR and value it and look at the fundamentals of the business, it values really high. It's still discounted by 59% after it's gone up 42%. So this one's moving fast, and I'm glad that I picked it up. I actually saw this in a super investor's portfolio and thought, hey, let me look at it, and thought, hey, I'm in the US. So with all this tariff talk, I sense that steel production in the US is going to become a big thing. And these guys are in the US. They extract the coal in the US and they deliver it to US steel facilities. I thought, well, that story makes sense. They could produce free cash flow. I take a very conservative approach to the free cash flow, and I get to a stock that's discounted. stock that's discounted that is on the move up. So this stock was at $400 a share. I don't need it to get to $400 a share. I am selling my stock when it gets to $200 a share. I will gladly double my money. Hopefully, it happens in less than a year. So, this is my cup of tea. It's not necessarily getting into companies like these here, but I respect that you made money on them. Congratulations. I just wanted to offer up one more company that is in, I would call it in the category, if anything. These companies are involved in mining, not necessarily a mining company, but wanted to share that with you. Yeah. I get that some people, well, met coal is it's used, metallurgical coal is used for steel, and steel is going to be necessary, right? If you're going to build buildings, for example, you're going to build a data center, you're going to need steel for the building, all the racks. You're going to need a lot of steel. You're going to need a lot of steel in all the piping that's going to deliver energy to that data center. If you look at cities, you're going to need steel for the buildings. If you look at infrastructure like trains, you're going to need it for the railroad rails. You're going to need it for buses. All kinds of steel is necessary. So I don't think it's going to be a material that we stop using anytime soon. And I know that coal comes with kind of a dirty name, but it is a necessity that we have for steel, in my opinion. Awesome. So thanks so much for all your interest in asking me to analyze 4 companies. Hopefully you found all my analysis interesting, and I hope to stay in touch with you. Thank you. All right, back to the comments. Boy, you guys are bringing it today. Thanks so much. So, Bushy, you want to take a look at PetroTal. I've got that noted. And Carlos, you want to look at Way? All right, put that symbol there. And then we've got Ben 10. How you doing, Ben 10? PRMB. Okay, PRMB. We're going to analyze PRMB and see what that's all about. Let me keep scanning, make sure I don't forget anything here or I don't miss anything. All right, it looks like I'm all caught up. In case I missed your comment, you're asking for a stock. No, I don't think I missed anything. Please put it out there again. I missed one this morning. I missed 2 and caught them at the very end of the stream, and I felt bad that I had people waiting on it. All right, so let's get into this. PetroTal. So PetroTal. So this is on the Toronto Exchange. This is on the over-the-counter. Okay, so PetroTal engages in the exploration, appraisal, development of oil and natural gas in Peru, South America. The company flagship property is the Bretana Norte oil field located in the Maranon Basin of northern Peru. 100% of its interest in Los Angeles oil field located in the Ucayali Basin of central Peru. The company was formerly known as Sterling Resources, changed its name to PetroTal in 2018. It's headquartered in Houston, of course. Houston is a big capital for oil, and that totally makes sense. So do these guys do services? It looks like that. All right, let me take a look at their website and see if that might give me a better sense. Now, what's my experience in oil? My first job out of college was with a big oil company that's now part of Chevron. And I was an accountant and did the accounting for gas operations as well as petroleum product operations. So I learned a lot while I was in that job. Okay, sustainable future starts here. So it looks like they have these sites. Okay, so they're a producer. Okay. I wanted to make sure I was looking at it the right way. This is an oil producer. They're finding it and they're extracting it. Got it. So $451 million market cap, revenues 318. Look at these PE ratios. Geez, so low, but that's the oil business for you right now. Oil business, oil prices are down. The price per oil is not very high, which is why this stock isn't performing all that great. Now, back when we were in this um, inflationary period where oil hit like $120 per barrel, boy, you could have made some money on this stock. You could have gone from 20 cents a share up to 50, 55 cents a share. But since then, oil prices have kind of just they've gone from like high 50s to touching $80 a barrel. Now that's some volatility, but boy, if oil prices hit like $85 a barrel, these oil companies are really profitable, like really profitable. At $65 a barrel, they're profitable. They're just not making money hand over fist. They're just getting by with a profit. And you can see that, yeah, back when we had inflation on that oil, these guys were just cranking it out. Then they had the oil per barrel price came down. So the price they were being paid for their oil went down. We had a bump in 2024, but now we're seeing that bump go away. Quarterly, yeah, we had a bad quarter here in 2025, and that's principally because the cost per barrel has really come down. When we look at their profitability, their gross profit is nice and high, so their cost is really low. That's pretty good. That's pretty darn good. It's good margin. That's better than Exxon or Chevron. Margins of 74%. That's excellent. Really good. So they're getting the oil extracted very efficiently, and they're nice and profitable. These numbers look good. Let's compare it to Occidental. Occidental is an American company. They also extract oil. And looking at their cost of revenue, I think it's a little higher. Let's see what their gross margins are. Gross margins is 64%. So that's why I'm like, hey, these guys have better gross margins than Occidental. And Occidental is the stock that like Warren Buffett likes it. I bought Occidental, but I own more Chevron stock. Chevron's my larger energy stock. So that looks good. That looks good. Free cash flow, it's been a little bit, it's been nice and positive. That's good. So $108 million free cash flow. Right now, oil prices, I don't think are going to go any lower. I think there's a good chance they're going to go higher. So 109 million, I'm going to call it free cash flow. Let's see how much debt they have. Now that could be something that changes the whole valuation, but let's take a look. So here we've got debt of 105 million, pretty much even. They have a little bit of debt, not enough to talk about. All right, so we got 109 million. Got a business that's looks like they're operating quite well. It's international, which for me as a US guy, it'd be higher risk. At 109 million, if I multiplied that times 10, it'd be $1 billion. And yeah, this thing's discounted really, really nicely. Here's the thing. If you think oil prices are going to go up, this is a buy. I don't know if oil is going to go up. We have, at least in the US, the economy is looking better. So I think when the economy is good, people use more oil. And when people use more oil, the price per barrel goes up. So there's a good chance that oil prices are going to go up, and I could see this stock going up in value. But that's really your decision. I can run the numbers, and I'm going to show you that this thing's discounted 40, 50%. But it's not as easy as saying, hey, let's say a stock like Meta is discounted by 30%. Okay, that's one thing, but will this stock price rise? Now they have a big dividend, as you point out. You would be paid a very nice stream of cash, and that would be quite lucrative. If you like dividends, this one might be a good play. I don't value companies based on dividends. Dividends are fine. I don't invest based on dividends. Occidental pays a tiny dividend compared to the one we just saw. And have they paid that dividend consistently? They have. Well, at least for a couple of years. So this is $0.015. So that would be 6. So that'd be 6 cents per share over the 1 year. Okay, looks right. Payout ratio 75. They have the cash to pay it. So yeah, if you want that dividend, you're there. I would just, one thing, just the way that I invest. This is risky for me. Why? I'm doing business with a company that is headquartered, I think, in Houston. Okay. Houston, Alberta? It's Houston, Texas, right? I would think. I believe so. So Houston, Alberta. There's a Houston in Alberta. Okay. You learn something new every day. And yeah, so they have a Houston office. They also have a Calgary, Canada office. Okay. So they're incorporated in Alberta, Canada. All right. So the data didn't come through quite clearly on the site. So my point being is I've got a business that is in Canada with the assets way down in Peru and South America. What if there's political instability? What if something happens and there's a disruption to the operation? That would really hurt the company, and that would really hurt the stock price. That's possible, and it's a higher risk. Whereas Occidental, the risk of that happening, I mean, there isn't going to be much political turmoil of the magnitude that would disrupt the oil complex here in the United States. So that would be one thing that I'm like, well, that's fine. You can earn a dividend, but I'd rather find stocks that are going to double in value quickly, like 2 years, 3 years. And dividends, are, if they come along with a stock that I like, that's fine. That's great. But I don't use them as a decision factor for myself, other than real estate investment trust. So that's Petrotal. Good luck with it. I think oil presents a lot of discounts right now. You can find oil companies discounted big time because oil prices are not very high. And that's really the reality. All right, so let's take a look at Way. I think it was who asked for Way? So Waystar, never heard of this company. So it was Carlos. You wanted to take a look at Waystar. Waystar Holding develops a cloud-based software solution for healthcare payments. Its platform offers financial clearance, patient financial care, claim, and payment management, denial prevention, recovery, revenue capture, analytics, reporting solutions. It primarily serves healthcare industry. Looks good. They're in Lehi, Utah. Okay. 1,500 employees. This looks like a neat business. So there's software business focused on servicing doctors, medical practices, hospitals, and that kind of thing. All right. So we got a market cap of 6 billion, revenue 1 billion, 6 times the revenue for the company. Their PE, forward PE looks really good. This year's PE is a little low, or excuse me, the PE is very high because profits are probably fairly low. It's a strong buy with 19% discount over the 1 year. This is up 44%. Year to date, it's down a bit. Over the 5 year, it's up 64%. So this one's kind of undecisive on which way it's going to go. It's not a clean upward trajectory. We got growth, very good growth on revenue. Looks good. Looks like customers like this software. They keep buying it. They keep renewing their contracts and subscriptions with them. When we look at the quarterly, we're seeing the percentage decline a bit. Now that doesn't worry me too much so long as it's not falling off a cliff. And it looks like we've gone from 21% down to 15%, and that 21%. Seeing if it's cyclical. No, they grew nicely. Okay. So that's pretty decent growth. It's a $1 billion revenue business. That looks good. Cost of revenue is 330 million. So their gross margins are 67% or so. All right, 67%. They have good free cash flow at 278. See how this is growing over time. This is one of those businesses that I like, that I was referring to earlier in the stream, where these guys have good margins. They're in a business where you write this software once, you can sell it to as many customers as would want to buy it. You don't have to rewrite it every single time. You just sell them the same source code, the same, code base, and you can make lots of money on each incremental customer. And that's what they're trying to do. The more customers they get, the more free cash flow, the more profit they get. At $278 million of free cash flow trading 12 months. And their margins could expand if they get bigger. They do keep a lot of that profit, and looks good. So 278 million. Let's take a look at their balance sheet. Make sure the balance sheet doesn't have a bunch of debt. And they have 341 million of cash. They have 1.26 billion of debt. So we're dealing with a company that has $914 million in net debt. Now, when we look at that and compare it to EBITDA, debt to EBITDA, 3.39. This is a concern. You don't want to be above 3. You want to be at 3 or less. And this represents, kind of simplifying it, it takes 3 years, 3.4 years to pay off the debt if they just solely focused on paying off debt. And that would really hurt the business because they wouldn't focus on making their product better, investing in research and development, and so forth. So that is a red flag. It's like, hey, why do you have so much debt? So you have $1 billion roughly of debt. So I'm going to take that into consideration. They have good cash flow, 278 million. And let's take a look at, so 278, they're growing nicely at 17%. So if I were to go 278 times 20, I'm going to get roughly $5.7 billion. Now, if I went times 30, I'd get to about 8.2 billion. So that's kind of like the range. And they have that $1 million of debt. So I would decrement that from the value. So best case, this business is worth about $7 billion to $8 billion. That's not a big discount on a software company. This one here, it looks interesting, but that debt is a concern. And there's a lot of like good software plays out there. We saw early in the stream. So this one here is not good enough. And when we look at software companies, let me show you a couple that look pretty decent that are similar in business. And I didn't want to do that. Let me go back to it. The one that came out was Monday, and their earnings were really good. the stock went up 5-day. Wait, I think I'm thinking of a different company. So this is Monday. Its stock tanked on the 8th. I think I got my wires crossed, but this has good growth. You can find a lot of software companies. For some reason, software isn't getting bought as often as like AI stocks. They're in the big sector technology along with semiconductor companies and so forth. But you find a lot of software companies that are discounted right now. Monday, I looked at it and it looked good. Let's see if I have the valuation here. So the valuation on Monday looks good. They're growing well. They have about a 36% discount. If you just look at cash flows, 48% discount. And you look at Salesforce, it's discounted. This is a very well-known company, has a huge addressable market. So there's some good businesses in the sales in the software industry that look really good. And I'm trying to see if I have DocuSign out there. DocuSign had been sold off like over the last month. And I have a nice discount on DocuSign, 35%. These guys keep growing like 10, 15%. And they're very consistent. So there's good deals on software companies right now. So many, like in any market, right? You shop around. And if I look at Waystar and look at the peer companies like DocuSign and others, I like those businesses more because this one's a little kind of specific to one industry, just healthcare. So it's kind of going to be limited in its addressable market just to healthcare. So that might be a limitation on their addressable market. I don't like their debt. And if you look at DocuSign, they have all cash. They have a lot of cash on the balance sheet. So take a look at your options in software. And you have access to my valuation spreadsheet. Since you're a member, look at that shared folder and look up the software companies that I have in there. You go Control F, you can look for DocuSign, look for CRM, Adobe. There's a lot of companies that I value in there. And you can take a look at those valuations and do your homework. If you like software, I think it's a terrific industry. There's a lot of good companies to choose from in software. Take a look. Thanks for asking. All right, so we want to hit PRMB, and I've got it mentioned. I've got a 15-minute time limit, but I think we can cover a lot of ground in those 15 minutes. So PRMB, this was a super chat request, and we are going to dig into it. Ben 10, I think you've been on the channel before. Good to see you. And Primo Brands Corporation operates as a branded beverage company in North America. It offers solutions through water dispensers, direct delivery, refillable, reusable bottles, pre-filled water exchange program, and water filtration appliances, as well as operates self-service water refill stations. Okay. So these are their brands. I'm familiar with this one. This one I buy at the store. I'm familiar with this one. So this one here, one of my clients, I'm in the software industry. They're exactly in this business. So I got to know them well. I actually went into their production and got to know how they produce their bottles and how they pull water out of the local water source, filter it really nice, add fluoride, and then bottle it. So I'm familiar with this. And they started off way back when they would deliver these big bottles. I think this is 5-gallon bottle, if I'm not mistaken. So I get that. Okay. So I'm familiar with the business. Now let's take a look at the fundamentals. Over the 1 year, this is down 2%. 5 year, I guess they IPO'd. They IPO'd November 11th, 2024. So they haven't been around a whole long. They're in the consumer staples, non-alcoholic beverages. Okay, got it. $9 billion market cap, revenue $6 billion. Forward P is 16.4. Okay, for a staple company, that's a little high. Dividend 1.64. Price target should be priced, or the stock targets are 65% higher. Now they IPO'd. This has been around for 9 months, 10 months, about that length. Okay. So let's take a look at the fundamentals. Wow, that's pretty good growth there. Revenue growth year over year. When we look at, wow, that's really good growth. 31%, 42%, 28%. What is going? Did they acquire a business? Okay. And I'm going to look at their balance sheet to see if they acquired a business. I'm going to look at their debt. So you see how long-term debt, this is in billions. So they were at 3.3, 3.4, and then they jumped up to 4.9. So that's $1.5 billion that they probably used to acquire a business. So that's it's good that they're growing, but it's acquisitive growth. They paid in debt. So they have $4.9 billion in debt. I'll take that into consideration. All right. So we've got organically, they were growing single digits. They're probably consolidating different brands and trying to get bigger and bigger. Maybe have more, bigger, stronger relationships with like grocery stores and stores that sell their bottled water. Okay. So their revenue is $6 billion. Gross profit is roughly $2 billion. So they're about a 30% gross margin business. Free cash flow, 353. Okay. Gross margins, 31%. Okay. So Ben 10, this stock here would be a good stock for probably an older investor that just wants something that's easy to understand, stable. Wouldn't be for like a young investor that's like, hey, I want to find a really nice stock that multiplies my money times 5 in the next, 5 years, 10 years. This one here is going to be kind of a steady Eddie. It's not going to be an overly, big appreciating stock, and the dividend isn't all that great. So let's do the valuation, and we're going to get to, I think, a valuation that's not going to satisfy most investors. Let's take a look. So I don't have a lot of beverage companies, but I do have Kroger. Kroger is a grocery company, and it's been a good stock for me. This is the only consumer staple stock that I own. It's a good one to own. I've doubled my money over the course of 5 years, so that's good in my book, especially with a low risk stock like that. But what I'm trying to do is I'm trying to find, the next Meta, the next Robinhood, the next Nvidia. That's where I think I'll make a lot more money. I want to make money quickly, not slowly, without taking excessive risks. I want my cake and I want to eat it too. All right. So the ticker on that was PRMB. Is it Prime Brands or Premium Brands? Primo Brands. Close. Primo Brands. So this is low risk. It's a stable company. They had, was it 368 of free cash flow? So we have 353 of free cash flow in the trailing 12 months. Now, when they're acquiring businesses, we got to be careful not to totally buy into the growth, because yeah, they grew, but they grew because they acquired another business. So it's not like they're going to be growing organically by these rates. Okay. All right. So what would be a more logical growth rate? Probably like 5%. That would be a logical growth rate within consumer staples. So that's what I'm going to use as a growth rate. All right. So we'll go 5% in years 2 through 4. It was 353. All right. So that sets up our cash forecast for the next 4 years plus terminal value growing at 4%. Gets us an intrinsic value of $8.9 billion. Now, this is where I include the debt, because if we just went on this number, it'd be like, oh, hey, this thing's discounted. But you'll see that the debt is actually going to take away from the overall value of the business, and it should in my book. I used the analogy earlier that, and let me get to this and then I'll come back. 5.3 billion. So 5.3 billion in debt, 420 million in cash. And then the shares outstanding was, let's see here, shares outstanding 373.52 million. 373.5. So this debt is what takes away a lot of the value. I used the analogy earlier that if a company had a bunch of cash, it's like buying a car, a used car, and they're telling you in the trunk of the car are $5,000. You're like, great, I'm going to buy the car and I get $5,000 included. Well, this would be where, hey, I'm going to sell you the car for $10,000, but then you got to assume a loan and pay another $7,000. It's like, whoa, wait a second. That doesn't sound like a very good deal. Here it's like, okay, I'm going to buy the company. I'm going to buy a fraction of the company, but we're going to owe this money to somebody. And that's not as good overall. The equity value is $4.2 billion versus the 8.9. And let me double check to make sure we're getting the right market cap. Yeah, 9.2. So when we compare that, this just is not investable for me. This is not a business that I like. It's not growing. The stock price is getting sold off. Maybe other investors are kind of doing their analysis and saying, wait a second, this is not a business that's going to make a ton of money. Let's take a look at earnings per share and just kind of land the plane with earnings per share. So some analysts are quite bullish on it. And earnings per share may get us a better number. It's going to be earnings per share of $1.60 and then $1.87. Okay, so we're going to go with $1.87. And the forward P is 13. Okay, we're going to grow it by 10%. 187. I'm going to go with a P at 12. Actually, a 16 is fair because they are growing really well. They're not growing really well. They're acquiring businesses. That's not the same. When you acquire a business, it's not the same like organic growth. So I'm going to go with that. So this guy here, it's just not investable for me. I'm right next to Kroger. Kroger's discounted by 13%. These guys are rock solid, diversified grocery company. They pay a dividend. So if I want a staple company, a safe stock, I've got Kroger. I've got other stocks that are just solid. They don't have too much debt. They have really good cash flows. I'd rather go there. Primo Brand's just too risky and riskier than Kroger. And they don't have the fundamentals. It's not adding up for me. So hopefully You found my analysis interesting, Ben. Thanks for the sponsorship of the super chat. And it's good to see your name. I think I've seen you before. Please keep coming back. And then, all right, we got 5 minutes to go. So, I think it's Bushy. You're asking for Bobby. Okay. And here's the thing: is we have the investor call, the paid member investor call, starting in 5 minutes. So if you join us on the investor call, you should have an invite already. We'll go over that one, and then we'll go over bone support. Is that right? Bonix. So we can go over Bonix on the member call. Just keep talking. Oh man. So KGel, man, you're the greatest. Thank you so much. So Bonix. So I noted Bonix. So we can go over Bonix. Yeah, you're welcome, Ben. So KGel, thanks so much. So what? So here's a couple of things that I do to find stocks. First, I like going to places that I have personal experiences with, and then I do screens, right? And there's some good screeners out there. I like Stock Analysis because there's no advertising all over the place. And like if you go to Yahoo Finance or others, they advertise like crazy, and it's a very busy screen. So let me show you their stock screener, and then show you how I would go down a thread. So here's the stock screener. And what you can do is, again, I like looking at stocks that I really, really like technology, software. I like communication services. And if I I'll put in things that, for example, small cap. Let's do a small cap screen here. We're going to look at market cap, and let's see, add filters. So we're going to go market cap. I don't care about the price change there. I don't care about the price change there. And I want to look at, so I told you that I like free cash flow. So you can go in here and you could say, okay, we do like market cap, free cash flow yield. Okay, that looks good. And I want it like sales growth. So show me some sales growth. Sales growth, sales growth. Bear with me. I'm trying to find it. Here we go. Revenue growth. So we got free cash flow, revenue growth. What else is important? Debt to EBITDA ratio, right? We don't want a bunch of debt. So I'm going to pick this guy while I'm next to it. Cash to debt, debt to growth. Okay. Debt to EBITDA. Okay. So there I picked what's important to me. Debt to EBITDA, revenue growth, free cash flow yield. So I picked those guys off. And now I've got this screener pretty active here. So price, I don't care about price. I'm not going to look at that. Revenue growth. So I want to see things that are over 10% revenue growth. And I want to see market cap. I want it under. So I'm going to go to mid cap. And you can pick like mid cap, small cap. And I want free cash flow yield. Let's start with over 10%. We may have to play around with that. Debt to EBITDA, I want it to be under 3. And I think I get to pick, I want it to be under 3. Okay. So 5 stocks just popped out based on that type of analysis. I already own this stock. I already own this stock. So those are okay, great. I own the right stocks. But now look at this one, StoneX Group. Let's take a peek at that one. And that's how I would do a screen. That answers your question there. And man, you've sponsored my live streams so much. I'm going to reach out to you and maybe we can schedule a one-on-one and I can kind of answer more questions one-on-one. So I just went through a screen, but I've got to go because I'm going to have a group of people waiting for me. Thanks for asking. Thanks so much for your sponsorship. I'll reach out to you and provide you my details and we can schedule a one-on-one. But this one here, what's this one all about? StoneX Group operates a global financial services network, connects companies, organizations, traders, investors to market ecosystems. So they're in financial services, capital markets, financial services. 4 billion revenue. PE looks good. PE looks good. Financials. Wow, they're growing nice. And everything else should line up. StoneX. Okay, I'm going to look at that later. All right, guys, that was a cool stream. Thanks so much. So really appreciate everybody's attention tonight or attendance. And I wish you well. I think we're in a real, strong market. It just keeps going up. And let's see how high it goes, man. And really look forward to the next one. And I'll reach out to you, KGel. Thank you so much for all the sponsorship you've provided in the last day. And I'll talk with some of you on the member call. Talk to you soon. Take care, everybody.